Hello and welcome to a recap of our lecture on provisions. So provisions was under IAS 37. What did it cover? Well, we looked at provisions and contingencies. Provisions, remember, were a liability in the financial statements where we're not sure of the amount and we're not sure of the timing. Now, prior to IAS 37, we had some problems with this because accounts could be manipulated by accountants using provisions to smooth out their profits. So they would maybe have inadequate disclosure of what the provision was for. They therefore had big bath provisions, so big provisions that they could use to release as and when they required them to smooth out their profits. So they had discretion to do that before IFRS. Now, under IAS 37, remember we need three things for a provision to be recognised. We need a present constructive or legal obligation, a probable outflow of economic benefit, and we need it to be reliably measured. Remember, a present obligation is an obligation that has been created now. If there's no obligation now, i.e. it's something that we intend to do in the future, then there's no provision. And remember, when it comes to that obligation, it's not just an intention. It has to be a legal obligation, so that would be a contract or maybe under law, or a constructive obligation, which would be based on your past actions, which could create a valid expectation that you would do something. So we looked at how to do those in illustration 1. The treatment then for our provisions, well, the value of the provision must be the most reliable estimate you can get. So for one item, that would be the best estimate based on the best information you have. So the most likely outcome. For many items, well, we can use expected values based on the probability of each outcome and the value that it would entail. We then went on to look at contingencies. So for liabilities, this is where a liability is possible rather than probable, or we can get no reliable measure of it. In that case, we can't create a provision, but we need to disclose that as a contingent liability. When it comes to assets, well, we can create an asset if we're virtually certain that we're going to get the income or whatever it happens to be. But it's more likely that we will simply disclose it when it's probable. Virtually certain is a very high bar to get over. So you need to learn this table. For a liability, if it's virtually certain, we create a provision. If it's probable, we create a provision. If it's only possible, we disclose a contingent liability. If it's remote, there's no disclosure. For an asset, if it was virtually certain, we would create the asset. If it was probable, we would disclose a contingent asset. And for possible or remote, no disclosure required. So you need to learn that table and be able to apply it in the exam. We looked at some specific examples that may come up in the exam, so types of provision. Remember, future operating losses we can't provide for as there's no obligation to make them. Onerous contracts where we've entered into a contract where the benefits are less than the costs, so perhaps things have changed, the economic environment has changed and it's going to lose us money on that contract. Well, for this we can recognise a provision because the contract is an obligation. That's a legal obligation. And we looked at that in illustration 2. Remember restructuring? Well, if the entity is restructuring, that will entail some costs. Can we provide for those costs if we're going to restructure our business? Well, we can create a provision if we have a detailed formal plan that's not going to change, and we've created an expectation that we will carry out that plan. That expectation would be expected if we had started to implement the plan or we had announced it formally. So if there's a detailed formal plan that's not going to change and we've announced it, then that would be an instance where we would create a provision. What could we provide for? Well, we provide for not ongoing costs, but just the necessarily entailed costs of the restructuring. And we looked at a detailed example of that in illustration 3. Other things we needed to be aware of on warranties. Well, remember, these are things that are given to the customers, guarantees in effect, to replace or refund defective products. Well, if we have created a valid expectation that we have a warranty, then that would lead us to need a provision for it. So if there's a valid expectation at the time of the sale that they can have their item replaced or refunded, well then we would need to create a provision for that potential warranty. We would use expected values for that based on past data and the previous costs that had been entailed and the previous amounts we'd had to pay out. So we looked at how to do that in illustration 4. Lastly, for environmental costs, remember if a mining operation, for example, had a legal or constructive obligation to clean up after its mining, well then we could create a provision for that. So if it's a legal requirement or we're expected to do it, we will create the provision. If we're not going to do it for a while, we will discount that to present value and unwind the discount. So we looked at a detailed example of how to do that in illustration 5. So that was a recap of our lecture on IAS 37 provisions.